Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back to another weekly market recap here at the end of the year as we head into the holiday seasons. Here with my good friend Lance Roberts as usual. Hey Lance, and happy holidays.
Happy holidays. I was going to wear my Santa hat today, but he didn't come to town, so decided not to.
Okay, yeah. And that's what I wanted to start off with here, where it looks like the Santa Claus rally might be skipping town this year. What do you think?
Well, technically, it's the last 5 days of the year, so we still have next week, right? So hopefully, we'll kind of get some traction. Markets were up a little bit on Friday, so we'll see how this kind of carries through. But look, even the market is going to have an exceptionally strong rally next week. Not saying it can't happen, but we're going into the last 5 days of the year with the Dow down like roughly 6% for the month. So you're going to have a really strong rally to turn December into a positive month. I really don't see how that's going to happen, but we could definitely get some buying next week. We still have end of the year portfolio window dressing for mutual funds, hedge funds, pension fund managers, et cetera. They've got a lot of cash on the sidelines and they're going to have to get that put to work, but certainly has been a disappointing month so far.
Okay. Let's see. I've been reading the headlines over the past day or so, and all of a sudden there are these headlines about stock buybacks becoming halted by a lot of companies. How material is that to the picture here?
Let's see. Since 2011, stock buybacks have accounted for 40% of the rally, and in the last 4 years, they've accounted for almost 100% of the net purchases. So, yeah, I'd say they're pretty important.
Okay, so it's kind of a big deal. Well, how widespread is it right now? Is it just a couple of companies that are announcing, or is it a material enough amount that we should be here's
the thing. If we're going to get into a recession next year, so just assuming, right? So I'm not saying we are or we aren't. So nobody go jump off a cliff just yet. But if you assume that you're going to have a recession next year, corporations are going to become more defensive of cash. So in other words, they'll start hoarding cash to make payroll and to meet obligations, those type of things. If you take a look at loans, bank loans here lately, bank loans have been rising rather sharply over the last month or so. That's not surprising. Everybody's like, well, why is everybody borrowing money if the economy is going into a recession? They're tapping credit lines. They're either setting up credit lines or tapping credit lines to have cash available to weather a downturn. So again, what we'll see here is as companies become more defensive about protecting profitability, so that's, cutting employment, cutting wages, cutting hours worked, hoarding cash. So instead of spending money on stock buybacks, I'm going to sit on that cash to get through whatever tough time may be coming. So, it's not going to be surprising that we see more companies do this. Just it hasn't become widespread yet, but it's certainly something to pay attention to as we head into next year.
Okay, couple of things you mentioned there. One, let's start with the increased borrowing. There's a chart I saw this week. I'll try to find it and put it up on the screen here, but showing a resurgence of activity in the Fed's discount window.
Yep.
Right, which is basically that's where you go to borrow when you start to get in trouble. As a big player here, and it's not at the magnitude that we saw at previous spikes in recent years, but it's clearly picking up here, and so that seems to be a sign that players are beginning to stumble here. Correct?
Well, yeah, when banks go to the discount window, that's not something they want to telegraph and let everybody know they're doing. It's always done kind of quietly in the background. And again, it has come up a little bit, and to your point, it has not become a point to where all of a sudden we should really be paying attention to it. But it does clearly show that maybe banks aren't quite as solvent as we've been led to believe. We've been told by all the the Fed and media is like, oh, the banks are completely solvent, no problem. Well, my only question has always been, why is every time we get into an economic downturn or recession, the first thing we have to bail out are the banks? If they're so
right.
Why do they keep you to get bailed out? But that aside, it is something that at least worth paying attention to. But again, it's not to levels that the Fed's going to immediately pivot and start cutting and doing QE. We're not to that level yet, but if we do get there, the Fed will.
Right, but it's consistent with your earlier point that companies are tapping credit lines and becoming more defensive. And in this case, these are some companies that maybe are even more overextended and are needing to get some help from mom and dad, and it might get worse.
Exactly.
Okay. Another thing about these buybacks, you and I have railed about them for a long time, so I don't want to crack open that whole rant again. But as I think I said the last time we talked, what management says when they do a stock buyback is they basically say, we can't find a better use of our capital anywhere else in the world than buying our stock, this particular company's stock, right? And of course, if they're all doing it, then all of them except one company is wrong, because that company would have the best prospects and everybody should be investing there. Right. And what's so interesting to me is they've been buying their stocks with these buybacks, as you mentioned, as their stocks have been hitting high after high after high, over the past 10 years. Now that stock prices are really low, you should almost argue like, well, that's when you should be buying your stock, right? That's when it should be, it's on discount, right? But of course, that's when they freeze the stock buyback. So to me, it's a really strong sign that these buybacks are just all about propping up price. They're really not about, making a fundamentals-based decision.
Right. Well, I mean, look, okay, so, you got to kind of unpack that just a smidge, because the reason they're buying their shares back when asset prices are rising is to do exactly what you said, which is to make asset prices rise. Why? So that all the executives that are compensated by stock shares can exercise those options, because they're given options, and if the strike price of the stock is not above whatever the option is, then it's worthless, right? So executives don't want to see their options go worthless, so they want to make sure that those prices are high enough to exercise those options. But the same thing occurs when the prices are falling. They're going, why should I buy it here? Because even if I execute that money now, I'm not going to get the stock price back to where those options are. And so it's just a waste of money. So that's why they start freezing them up and defending cash, right? It's, to your point, it's the least best use of cash because it only benefits the C-suite executives. But instead of investing it in the company growth long term, they do this to help enrich in the C-suite, guys that have all the stock options. But again, when markets are down like they are now, you and I are going, now's the time to buy back stock, and they're going, why? It's a complete waste of money.
Well, exactly. Yeah, that's what I'm saying. It's revealing the game, right? That the game of the buyback is not to help
anybody,
a long-term shareholder. It's just to juice it to short-term C-suite enrichment. Yeah, exactly. Okay. So one of the companies that basically is I don't know if they didn't say they're not going to do buybacks, but they said they're not going to do share issuances for a while, was just Tesla, which just came out. And I talked briefly about this in my video yesterday. Tesla was the high flyer stock, right, of the whole, Fangman Vanguard, even though it wasn't in that acronym, it was included in there, right? It was the whole Cathie Wood, high growth tech. And it really was a bulletproof stock. I mean, there's nothing could seem to stop the meteoric rise of that stock. But what a difference a year makes, right? It's down like almost 70% since its highs at the end of last year at this point in time. I'd love for you to opine on anything about that. It's just a big bellwether falling this far and this hard. But along with that, you might remember I interviewed a guy named David Traynor about 2 months ago. The focus of that video was zombie companies, because his research firm was putting out research of, trying to sort of quantify how many companies were zombie companies and what it could mean if they really started to fail. And he had said that Tesla had been such a speculative vanguard for the markets, and so much hot money went in there, and there were, tons of naked call buying, and just, it really was this magnet for speculation. And he said, when that stock stumbles enough, it may set off a chain reaction that's going to force a lot of these speculators to go into kind of, wound licking mode. And that could be really damaging to a lot of the equities of the other zombie companies, and it could maybe start some sort of cascade effect. So I'm just curious, how important is Tesla's woes here right now?
Well, there was an interesting analysis that was put out. I mean, if you take a look at all the retail meme stock holders, right? Remember the AMC, the GameStop,
GameStops, yeah,
all those meme stocks.
Bed Bath and Beyond.
Yeah, those retail, and that's part of that is Tesla, by the way. That whole 2-year adventure into speculative gambling has died its worthy death. I mean, it's what we knew was eventually going to happen when you buy companies that are fundamentally unsound. And it's interesting. You talk about Tesla being down 69% for the year, which is true, but you got to put that in some context, right? So here's a stock that has had, just as you said earlier, a meteoric rise. They split the stock. Elon Musk came out yesterday and said, I'm not going to sell any more stock until 2025. Probably a good thing at this point, right? Just stop the bleeding at some point. But you've wiped out. Now, when you talk about a stock being down 69% this year, right? So that's from the peak of the market this year to where it is currently. And you go, wow, it's down 69%. That's wiped out. And think about this for a minute. That's wiped out basically almost 3/4 of all wealth that was created in the stock since the company went IPO, right? Because if you lose 100% of the value of the stock, it's zero, right?
Right.
So,
and if I just interject for a second, I think I heard yesterday that the market value that has been lost in Tesla that you're talking about over this past year,
yeah, I was just about to say this.
More than the market cap of every other U.S. auto manufacturer. That one, yeah. Okay, sorry.
Yeah.
Sorry.
No, so I was getting to, and so you start putting this in magnitude, right? So the value of Tesla was valued at more than every other manufacturer combined, put together. Now they've lost market cap relative to every other auto manufacturer combined. So, there's just no way. And this has always been the argument with Tesla. And of course, everybody, all the Tesla fans were, oh, well, they're a technology company. They're not an auto company. And, okay, yeah.
You just don't get it, bro. Yeah, exactly. Yeah.
But eventually, at the end of the day, look, you make cars. And and you and I had even talked about this, I think, earlier this year. We were talking about Tesla. And it's like, look, it's just a function of time until they lose market share, because every other auto manufacturer, they set back and they go, let's see if this thing works. Let's not commit a bunch of capital to developing electric cars until we see if there's an actual market for it. Tesla did a great job. They established the market. They built a car that people wanted, people bought it. Well, until he bought Twitter, and then all the people that bought the car doesn't want it anymore. But that's a different story. But the point is that now that the other automakers step back and they go, and by the way, Tesla made all of their technology available for free, right? So, so all the other auto manufacturers said, okay, people obviously like this, let's build cars. And so when all these other manufacturers were building cars, what we said was that it's just a function of time until those cars start eating into the market or the market share of Tesla. Right. Tesla had 100% of the electric vehicle market. Now they don't. And that erosion is going to continue. So at the end of the day, they can be a technology company, they can be a spacecraft company, whatever you want to call them. You still have to justify valuations based on how many cars can they produce and sell. And Ford sells more cars in a month than Tesla does all year. So, I mean, you just got to, when a company is worth more than every other auto manufacturer combined, you had to realize that at some point valuations were going to matter. It was just a function of time.
Yeah. Pulling on that, my neighbor, I think I mentioned to you, works for Rivian, which is an electric truck manufacturing company. And to your point about other competitors eventually catching up to Tesla, yes, not only did they see what Tesla was doing and start copying, but Elon Musk is a tough guy to work for. Tesla's a grinding place to work for. So over the years, it has spit out a lot of people who were instrumental in getting things up and running there, but for whatever reason ran afoul of Elon or just got tired of, they got burned out or whatever. And then they've gone to these other companies and they brought, their know-how with them, right? And in the case of Rivian, there are entire departments at Rivian that were hired away en masse from Tesla. So like when my neighbor went to go work there, she said, "Oh, it was the easiest transition I've ever had, because literally 1 week I was working with all these people at Tesla, and then the next week I was working with all of them at Rivian." Right? So there's a lot of talent poaching like that I think accelerates, the dynamic that you're talking about there. All right, so on this topic of I guess speculative stocks. So another interview I did last week that I think was a really important one was with Peter Atwater, and he's an economist and he looks at all the data, but he says my specialization is looking at indicators of confidence. So at the end of the day, a really nice way we sum this up is conventional wisdom is that people make rational decisions about money, right? Behavioral economics says people make irrational decisions around money because we are human animals, right? And it's our evolutionary wiring that gets in the way. And Peter's confidence work says, well, we make rationalized decisions, right? Which is whatever stories, whatever narratives are dominant in our minds, we use to then rationalize the decision we're going to make. So it may make sense to us. It may not be the right decision, right, but it makes sense to us based upon the story that's in our head. So he looks at sort of the stories that are deriving the decisions that the decision makers make. So he says he looks at factors of invincibility and vulnerability, and clearly investors in Tesla up to the end of last year, crypto investors up to the end of last year, meme stock investors up to the end of last year, they had this sense of invincibility, right? We're part of this new paradigm, and bro, you just don't get it, and this is going to the moon, right? We're now seeing that crack. I don't know if I would say it's completely gone yet, but it's definitely been severely wounded, diminished this year. And why I'm kind of harping on this is because that's the speculative end of the market. And you have said, Lance, many times that a bear market is over when people have capitulated and they don't want to touch stocks at all, right, as a class. And so on that journey, you give up on the speculative stocks first, right? And then you switch over to, the value stocks. And then when they break your heart, then maybe you give up on stocks as a whole. So is this sort of an important milestone we're seeing here where the speculative side of the market's beginning to capitulate, and it's not necessarily giving up on all equities yet, but it's saying, all right, maybe I'm kind of giving up on this part of the market. I'll hide in this one. And of course, we'll see what's going to happen next year. But this could be an important milestone, correct?
Well, yeah, and here's what they're doing though, right? And so some of the latest data, there was a chart out last week showing the number of the amount of asset flows coming out of actively managed stock funds, right? So what investors are doing is like, oh, this market sucks. I hate it. I can't make money at everything I buy just goes down. So I'm just not going to buy stocks anymore. I'm just going to buy ETFs. ETFs have had the highest inflows, passive ETFs, right? So, your S&P index funds, your Dow Jones, your triple Qs, your sector ETFs, those passive index funds have had the highest money flows going into them this year since 2009. So, it's just been a massive flood of money coming out of actively managed stock funds and going into equity ETFs because they're like, well, I don't want to be out of the market because the market may go up and I don't want to miss out, but I don't want to be in individual stocks anymore because nothing works over there. So I'm just going to be in the indexes. So the problem is that we haven't destroyed the market enough. And we've talked about the passive indexing effect before, which is the reason the market's not down a whole lot more this year is because of all the money going into passive ETFs that are supporting the market.
Right.
And people haven't started selling those yet, and they may not. But, to get to the real bear market bottom, wherever it is, you're going to have those flows into ETFs reverse. And I'm assuming that'll probably happen during a recession next year. We'll see. But it's been an interesting year that, it's from the standpoint, psychologically speaking, it's like, well, screw it. I can't make money in stocks. I'm just going to go buy ETFs and just kind of join the crowd. But they're not getting out of the market entirely.
Right. So that may actually be consistent with what I was saying earlier, which is, in a hot market, everybody feels like a genius because any stock you pick pretty much goes up, right? And these guys were in the speculative edge of the market. So maybe now they're feeling burned, to your point, and licking their wounds and saying, okay, maybe I'm not the world's best stock picker anymore, but for all these reasons, I don't want to leave the market yet. So I'm just going to go into a passive ETF. So this is sort of the intermediate stage, right? And what this might be is it might kind of be like the tsunami, right? Where before it became such popular knowledge over the past decade or so, sadly, because we've had a few. What happens in a tsunami first is all the water goes out, right? So people are there at the beach, and all of a sudden the water has, vanished off in the horizon. And they're like, wow, this is fascinating. This ocean bottom is now exposed. And they all start walking towards the ocean because they're like, wow, we've never been able to walk out this far before. And then, of course, obviously, the tsunami then comes in and it catches everybody by surprise, and it's a massive tragedy. Not saying that that's going to happen here, but it could be that sort of phase of the market if indeed, we get a recession next year and then we get a continuation of the bear market.
Yeah, no, that's right. I mean, and kind of the tsunami is a good example of, or a good analogy, I guess, of kind of what potentially is going on. But again, that passive indexing effect is also hiding a lot of the devastation in the markets. And as I said earlier, that water would actually look like it was a lot further out if we didn't have all that money piling in ETFs that are supporting stock prices. Because again, as we've talked about, with these passive ETFs, when money goes in, it flows into the
Right.
biggest cap stocks at the top of the index. And this is why every time you see the market rally a bit, it's always where? In the big tech stocks,
In
right?
those big stocks, yeah.
Because those are the top weighted market caps. So whenever you have a day that's up 3% or whatever, and look at the heat map, it's always Apple, Microsoft, Google, Amazon, bright green, right? That's just because it's just absorbing 30 cents of every dollar, out of those passive index flows.
Well, so since we're here at the end of the year, I think it's fair to tell the audience here that this is a factor we'll be looking at really closely next year, which is just capital inflows, right? Because if they turn negative, not saying they're going to, but if, we've long talked about, and you've long warned that, if those, that dynamic shifts into reverse, where all of a sudden it's those big companies that have all of the capital in them that start shedding market valuation the fastest.
Yeah, exactly. And so, and again, I really don't have any clue what's going to happen next year. There's certainly a lot of case to be made that, we're going to have a recession. I mean, certainly plenty of indicators support that. The leading economic index came out much weaker than expected yesterday. Personal consumption expenditures are definitely slowing down here. Retail sales have been disappointing. I mean, so, everything you're kind of looking at is suggesting you're going to have a recession next year. But, you take a look at some of the employment data, some of the economic data, and again, that's super trailing data, so you got to be careful of it. But, you could make an argument that you might not get a recession, and I don't know how you don't. I don't know how you not having a recession. I really don't. But I'm trying to at least give some credence to those that say, oh yeah, we'll have a soft landing next year because GDP, nominal GDP is still 5-6%, whatever it is right now. So you got to crack a good bit of nominal GDP growth next year to get to a recession. And we just printed third quarter GDP at, what was it last week? 3%, something like that. So
yeah. So it's funny, Lance. I'm laughing here because you play a good role in these discussions here, where you really do try to bring balance. So that if some data we're bringing up here is it's reinforcing somebody's cognitive bias in a certain direction, you're trying to say, hey, keep your mind open to the fact that things might not go the way that you think. And that's what a professional investor has to do. You got to be prepared for all contingencies. I will say that I was kind of chuckling because around things like avoiding recession and whatnot, I feel like you're having to twist into even more contorted, mental gymnastics as the weeks go on. Because the probability does seem to be going up. But yes, there's no guarantees. I will say, on Wealthion, there's the parade of guests of late that have said a recession is baked in the cake for next year. I think Luke Roman, is it Luke Roman? Can't remember who, but somebody recently used the words inevitable. At this point, recession's inevitable. And I would say that that's the consensus. And maybe that's what's to be worried about, right? When everybody's on one side of the boat. Yep.
Yeah. And that's just it, right? I mean, if we have a recession next year, this will be the only recession in the last 130 years that has been forecasted to happen, right? Because nobody ever forecasts a recession to happen. I mean, if you really wanted to have a recession next year, what would be great is if CNBC starts trumpeting the fact that, oh, we're going to avoid the recession. All these indicators
Right.
suggest, it's going to be a soft landing. It's all good. I'd feel much better about the recession call. I'm a big fan of Bob Farrell, and rule number 9 says when all experts agree, right, something
Right.
else tends to happen, and it bothers me a lot that everybody is in agreement we're going to have a recession next year. But again, I'm not arguing the point. I try to get, as you said, I'm having to do some mental gymnastics over here to suggest that, hey, there is a possibility to avoid it. I'm not sure how we do that, but you have to give at least a little bit of weight to the idea in your portfolio that says, okay, so what happens if we don't have this big recession? What happens if earnings don't decline from $203 a share for the end of 2023 to the long-term growth trend of 160? We just did a whole analysis on our website at realinvestmentadvice.com talking about price targets next year, and they range from 4,500 to 2,400, all using valuation-based metrics. So the 4,500 target is obviously, hey, we can maintain 22 times valuations and we don't have a recession and earnings don't go down. And
right. if Fed sticks the soft landing. Yeah,
exactly. That's, we'll have a 16% rise in the markets next year. Not too shabby. You kind of expect that after a negative year in the market, right? And so, there's, you've had a lot of pressure on markets all year. You've got a lot of drainage. You've got a lot of people sitting in a lot of cash right now, and that's professionals as well as retail investors. So, you got to when you're managing your money, you've got to at least give a little bit of weight to what happens if I'm wrong. And because everybody can't be right, then right, everybody's saying it's a recession. So
very good point. For folks that want to see an active discussion of those various potential outcomes that Lance just mentioned, we actually went into them in a fair amount of depth in last week's weekly market recap, and with the charts and everything. So go watch that if you haven't watched it yet. All right, so a couple more market related stuff, Lance, including any trades you guys did this past week, and then I want to hit one or two quick topics on our way to the topic we punted on last week, which was sort of this large and growing cohort of prime age workers that are basically just mentally checking out of the workforce. And there's some reason why I want to spend more time in that than we have to date, because I think Lance and I both agree it's a big problem, but also may have some constructive advice to provide if either you're in that cohort, or if you, as I hear from a lot of people here who watch this channel, may have children, approaching maybe even early adulthood, who are feeling demoralized and maybe tempted to check out. So we'll dig into that in a bit. All right, so just one more bit of news I'd like to get your reaction to. This week, the Bank of Japan raised the cap on its yield curve control. Right, so it's been throttling the Japanese 10-year bond down at 0.25% for an awfully long time, and of course this year that's been killing the value of the yen as the dollar has strengthened, because it can only control one of the two. It can control what yields are, it can control what the value of the yen is, but it can't control both. It is now, after a long time, saying, we got to do a little pressure release here, and it's going to let the 10-year Japanese bond go up to I think 50 basis points now. So how big of a development is this?
As far as the development goes, is it going to change the dynamic of the world? No. But you and I talked about this, when they first started talking about yield curve control, we said exactly to your quote, which is you control one or the other, but you can't do both. And we now know the ultimate outcome of that. But, there's two things to take away from it. One, it just goes to show that yield curve control really doesn't work very well. It doesn't solve your financial problems. And what Japan has is a debt problem. And they have too much debt. They keep issuing more debt. And even in the yield curve control, there's basically been no buyers of debt. I mean, there's been whole weeks that go by that nobody buys any bonds because there's just simply no buyer there for them. And unfortunately, Lord help them, the people that we have in Congress, newly elected, oldly elected, doesn't matter who they are, just keep kind of kicking the can down the road. And we're just in the midst of trying to pass another $1.7 trillion in spending that we don't have the money to cover. And that's going to be more debt. And we're just going to keep, we're just in that same path as Japan now, going, hey, look, Japan's doing this. They're running all this debt to GDP. And it's, sure, they got a slow economy. Sure, they can't get interest rates off of zero. Sure, they can't do these other things. But it sounds like a great idea. Let's do more of it. And, we're just, I've written articles in the past called the Japanification of America. And you just look at the path and trajectory on, we've got so many, so many similarities. We've got, increasing debt, increasing entitlement, social welfare, aging demographic, kids not wanting to leave the house to go work, something we'll talk about in a minute. But, a huge cohort of the Japanese youth live at home with their parents. They don't work. They don't make households. They don't form relationships because they don't have a job, and they don't have that confidence, right, to go out and to produce and to create stronger economic growth. So what Japan did this week is, they lifted that yield curve control a bit, and immediately our bonds kind of jumped a bit because their yields went up a little bit, but our bonds were really overbought, so we had to have a correction. So I'm actually very happy they did it, because I'm looking for the next buy spot to add to our long duration bonds, hopefully right around 100 on TLT. But this is not going to work for Japan. It doesn't solve their problem. The only thing that's going to solve their problem eventually is a complete default, and they're just going to have to do that at some point. So, I mean, you talk about the Russian debt default, go look back at 1998, just put that about 500 times on steroids, and that'll be a Japanese default.
All right. Okay. So I don't disagree with it. And we could probably spend a whole video talking about this, but in a nutshell, in a sentence or two, what would a Japanese debt default look like?
Well, again, you and I were around in 90, 97, 98 when Russia defaulted, right? Markets.
Yeah, but Russia wasn't the world's third/fourth economy.
Well, exactly. And that's what I'm saying. So you put Russia on steroids, and that's Japan. I mean, look, we have, we have so many monetary transactions that are tied to the Japanese yen, right? So one of the big carry trades that has been going on for the last decade has been to basically sell JGBs and then margin them and then buy US treasuries with them and capture the spread between the two. So, you're talking about a ripple effect through the entire credit market if they ever defaulted. And look, I don't think anybody's ever going to let them default. I don't know how they work it out of them, but you can't let Japan default. There's too much debt tied to too much of everything else, derivatives, everything else, in the economy globally, that nuclear bomb, when it goes off, is something you're not going to contain.
Yeah, it's like that old saying, just on a national or international scale, right? When you own the bank $1 million, you have a problem, but when you own the bank $20 billion, the bank has a problem, right? Yeah.
Basically, Japan is everybody's problem. So,
I mean, okay, see how you like it. We're taking you all down with us, right?
Exactly.
Okay, so let's get to trades real quick. Any trades this past week?
No, we thought about raising a little bit more equity exposure. A little bit more cash exposure this week. We're still running about 35% equity. We're kind of looking maybe this kind of Santa Claus rally. We're oversold enough on a short-term basis. The sell-off in the first 2 weeks of December, we had talked about this back in November. I keep reiterating this, but back in November, we said first 2 weeks tend to be sloppy. That gives you the setup for the year-end rally. So we had that sell-off in the first 2 weeks of December. Nice setup for this kind of year-end rally. So we were thinking about raising some more cash. We wound up not doing it this week, just because if we do get a rally next week, we're so underweight equities, we're just not going to, we'll have no performance at all if the market rallies 4 or 5% next week. So we didn't do any trades. We're still sitting on our very base core exposure. Once we get into the first part of next year, we'll kind of assess where we are and then make some adjustments from there.
Okay. All right. I'm just going to mention it just because we're here at the end of the year. The vast majority of folks that have appeared on Wealthion recently, and I'm just fresh from the latest, interview this morning, which was Stephanie Pomboy interviewing David Rosenberg. I hate to say it's almost universal, because then we begin to pull in Lance's rule there that when everybody thinks something, it's not going to happen. But the consensus seems to really be gelling around a pretty rough Q1, maybe even Q2, a resumption of the bear market. Earnings recession really begins to kick in as the Fed continues hiking and tightening, right? Dollar may start resurging again. Then, of course, the massive question mark is there a Fed pivot or not? At the end of that, we don't know. We'll see. A lot of people like you, Lance, suspect there will be. They don't think that Powell's going to be able to stop and hang out for a long time, but that's what Powell says he wants to do. So the general arc is like, build cash. If you're aggressive, play with some shorts, but get yourself bond exposure, because bonds are going to do quite well this year, and really specifically U.S. Treasuries. Corporate credit's a whole different scenario, and there was a nice discussion today between Dave and Stephanie. Dave basically said, yeah, it looks a lot better than a lot of equities right now, prospect wise, but he says you really got to pick good companies, and you want to stay on the short duration side of things in the corporate credit world. So that, and then maybe later in the year, especially if there's a pivot, and that means a big policy response, we make our way through the earnings recession, earnings start to begin to recover, and then later in the year, stocks maybe come up again. Now, that's a massive generalization that I've just mentioned, but that seems to be sort of the arc, at least that a lot of the folks that have been on Wealthion are seeing through right now. I know, Lance, you're not in the business of guaranteeing anything or whatnot, but does that sort of feel a little bit like what you guys are expecting, or any material differences right now?
Yeah, no, that's exactly what that kind of our view is as well. And in fact, I was on Charles Payne this past week and was talking with him. I said, hopefully by this time next year, we'll be talking about the new bull market, right? So, the first half of this year, you get a fairly decent sell-off. You kind of rip through the next down leg of the market. And I absolutely agree with David's view. One thing we're talking about right now is, we've made available our bond sleeves to, Wealthion viewers. One of those bond sleeves is a corporate bond sleeve. And so, where we buy what we call money good corporates, these are corporations that have huge cash balances, strong financial, balance sheets. They're going to weather a recession, still be here afterwards. They'll pay their debt. But again, even with those bonds, fairly short in duration, not going out real long. What happens in a recession with corporates is that you'll see the yields go up and the bond prices will go down. And so you've got to this is why you stay short with those corporate bonds. And the reason for that is that when the selling really starts, if we do get into a recession, people really start to sell, they're dumping equities, they're dumping ETFs, they're dumping everything. It's kind of baby with the bathwater. As the price of the corporation goes down, people go, oh, maybe there's something wrong with the company I'm not seeing. I better sell their debt. And so the debt gets sold as well going into recession, because people worry about getting, the repayment of the principal. It doesn't even matter that they're, it's Apple or Microsoft or whoever. It's just kind of everything gets sold. And then, of course, the bond ETFs get dumped, and that causes pressure on the corporate side. The Barclays Ag Index goes down in value. That causes more pressure because it's got corporates in it. So there's a lot of ancillary knockoff effects that cause yields to rise and corporate bond prices to go down. The inverse of that happens with treasuries, which is where on the treasury side, those yields will go down, those bond prices will go up, because that's money flying into safety of the U.S. government. I want my money back. I need guarantee of capital. And one thing we're talking about right now is actually shifting our bond portfolio just a smidge here, probably next week. We have our long duration exposure, and then the big chunk of our duration in our portfolio is like 1 to 3 months. So we're going to start shifting some of that 1 to 3 month exposure to 1 to 3 year exposure. We're still kind of holding our longer duration in play. Those yields got too overbought too quickly. We had that big rundown in bond prices,
yields
recently, and bond prices went up on TLT. We've got 3 standard deviations overbought. Technicals apply to bonds just like they apply to stocks. that needed to pull back a bit. We're in the process of working off that overbought condition. It's going to take a little bit more work to get there, but we'll add to those long duration bonds. Probably, I would imagine, probably sometime January, February, we should get into the right position for that. So, that's kind of the play that we're going to be doing in these fixed income sleeves as well as our bond portfolios in
All
general.
right. And hopefully here on this channel, you will update us in January, February when you guys make the call. Like, yep, conditions are good. We're moving. Great. And so just to make it clear, we've said on this program a lot that, we can't wait for the days when we can really start talking about great opportunities to invest in that we're beginning to see.
Yeah.
And we very well likely may see more pain, especially as Jerome Powell and company are trying to engineer it to a certain extent. But it's looking like we think we will see a bull market in treasuries, and that'll be the first bull market of next year. It will then be followed by a bull market in corporate bonds. And then we may get a bull market in equities as well, but that is likely to be later on in the year as best we can see so far.
Yeah, and typically your bond rally and your corporate bond rally is going to occur pretty close to the beginning of your stock market rally, because again, that's where appetites are getting better on credit quality. The market's starting to stabilize. Maybe the stock market's not rallying yet, but it's stopped going down.
Right.
People kind of stop. The panic's over, and you kind of start seeing the bond market heal up, and then that's a good precursor because it happens pretty quickly after. So to your point, treasury bond bull market, corporate bond bull market, and then right after that, you'll start your equity rally.
Great. So again, we're pontificating here, and so we'll get much more specific next year as we have real data to react to. But you can almost sort of see a rotation there, a play to rotate, right? Okay, we'll ride the treasuries, then we'll start getting some exposure into the corporate bonds, and then when they start taking off, that'll be our signal to maybe start nibbling in the equities.
Yeah, and look, and this is what everybody says, right? So, and just be clear about this. Is that everybody goes, well, I'm just going to sit in cash until that happens, right? When that happens, I'll get it. No, you won't, because when it starts to happen, it will follow a really bad spat in the market, and you're like, okay, well, this is probably just a reflexive rally, like we've had all year. We've had these bull rallies all year long that fail and go to new lows, and you'll say, okay, well, this is just another one of those things, and then the market will take off and start going higher. You're like, well, I'm not going to buy now because now the market's too overbought. I'll buy it on a pullback, and the market just keeps going, and you'll just never get in. Yeah. And so this is why it's important that you always maintain some core exposure. You're not 100% cash and gold and beanie weenies and bullets. Always maintain a little core exposure to equity so that when the market does start to take off, you're at least participating, and you can look back and say, yeah, I can see my portfolio doing better in my equity side. So I'm going to start adding to those guys. I'm going to get rid of the ones that aren't working. I'm going to add the ones that are working. And then as things start to heal up, you just keep adding to that exposure and making your bond shift. It's not a light switch on or off, because trying to do the light switch effect is timing, and you're never going to get the timing right. And that's just, don't even try to do it. Just manage it as you go forward.
Okay. So this is part of the what you talk about when you say often on this channel to be a good gardener when it comes to your portfolio. So this is a great segue into where I wanted to go next. I'm going to give you an opportunity to promote investmentadvice.com and tell people to go there to read your recent article, because you just did, we're here at the end of the year, and you just did, I think, a really good, sort of summarization, but I don't want to minimize the amount of work that went in here of really what you mean by gardening in a portfolio. And maybe we can just talk about some of the key points here. First off, you sort of talk about a lot of the behavioral foibles that most retail investors have that prevent them from being good gardeners. So I just wonder if we can dial through these really quickly. And maybe let's start with loss aversion.
Yeah, well, and you can kind of go through, through the 9 as a bulk, because again, they all kind of also tie together. Loss aversion is where I don't want to lose any money, so I do everything I can to avoid losses. Right? I'm afraid of losing money, so I'll go hide in cash, or I'll buy some other asset class because I'm afraid of losing money. And so you start making these psychological decisions to try to avert loss. But this also kind of falls into the other behavioral biases like the herding effect and contagion effect and all these other things that we do as a function of allowing our, and this is what we always talk about, looking at the data, right? And trying to evaluate the data for what it is, not what we want it to be. And like we were saying earlier, why do we give, some credence to the idea that we're not going to have a recession next year? Why do you give any weight to a soft landing? Because the Fed has never engineered a soft landing ever in history. Why do you give it any weight? Because again, everybody is talking about the recession, right? So we have to be careful of confirmation bias. And this is where, you listen to a video, or you listen to some television channel, or you read some website, and all they talk about is, it's all bullish or it's all bearish, but whatever your view is, that's all you read, right? You don't look at any of the other data, because anything that doesn't confirm your own beliefs, you reject as being wrong. And that's how we wind up, in these psychological entanglements, that we wind up doing the wrong thing for our money. We wind up making a 100% bet, short the market, and then the market takes off running, right? So, and this is why, when we talk about all these things from a psychological basis, it's about trying to avoid those pitfalls that we put ourselves into that cause us to lose money over time.
Okay, so great summarization. I think you said you've got 9 of those there. Folks, go download the article, go understand all of them, see how many of those you might be guilty of right now. So that's the behavioral side of things. Then you quickly touch on the math side of things, which, one of the most powerful forces in the world of investing is reversion to the mean. Can you just spend a second on why that's so important to understand?
Yeah, in the markets, right? And you go back in history, and it works with valuation or asset prices. We talked about Tesla earlier, right? Good example of Tesla. Tesla is in the process of reverting to the mean, which is all that means is, and kind of the best way to explain this in a simple analogy is think about a rubber band, right? So physics says that if I take a rubber band and I stretch it as far as I can in one direction, now, this is what physics says. If I let go of that rubber band, once I've stretched it, it will snap back an equal distance in the opposite direction. Then, of course, it'll wiggle back to the middle eventually if I don't re-stretch it. And that's what happens in the financial markets all the time. If you get too far above a moving average, prices will ultimately revert back to and beyond the moving average. They have to, because you have to have, in order to have an average, prices have to trade above or below that average over time. Profit margins, profits, earnings have to mean revert. If earnings don't mean revert to the long-term growth trend of the economy, capitalism is broken. And we can make some arguments about capitalism being broken, by the way, but earnings have to mean revert. Valuations have to mean revert over time. Otherwise, capitalism is broken. Because again, when we talk about what works in the market, right, and what drives capital appreciation and stock prices over time, it has to be a function of earnings. Earnings ultimately support higher asset prices, but earnings are only derived from economic growth. So if earnings are trading well above what the economy can actually produce, you're going to eventually have to have those earnings revert back to the normality of what the economy can produce. And right now, economic growth is growing at 2%. So you can start doing math pretty quick about figuring out where capital appreciation and earnings growth and those types of things are going to be over the next decade or so.
All right. So what's important to note there is the power, what we could say the inevitability of mean reversion, but your point of the relationship between how far you deviate from the mean is predictive of how far you will overshoot the mean in terms of, the correction when things reverse in the other direction.
And that's a very interesting thing, actually, Adam, if you take a look at valuations, right? So you take everybody's seen the chart of Shiller's KPE ratio, right? And if you look back over time, it regularly, Shiller's KPE was well above its long-term trend in 1929, then it corrected below it. And then we were above it in the 1950s, 60s, and we went below it in 1974, got down to 7 times earnings. But that's been an interesting thing over the last, 23 years now, is that valuations got well above that long-term growth trend of the world, right? Of the markets, the economy, everything else. Valuations only briefly came below that kind of trend in 2007, then went back up. And that's because we've been doing all these artificial injections, right? We haven't allowed the markets to do a mean reversion. And so here's kind of the interesting thing going forward that, that I don't think enough people are talking about. The Federal Reserve is talking about hiking rates and leaving them there. Again, we agree that I don't think they'll be able to do that for very long. But they're also tightening up their balance sheet. So what if over the next, and this is a what if, right? But what if over the next decade, the Fed lowers interest rates to 0, but they don't stop QT, right? Or they just don't do any more QE for some reason or the other. And you take that liquidity push out of the markets. Since 2009, we've added 4 percentage points of return on the long-term average of the market going back to 1900. So from 1900 to 2009, markets return on average about 8%. So that's economic growth plus inflation plus dividends. So that's your 8%. From 2009 to present, we added 4 percentage points on top of that, right? So that's 12%. Now that occurred during a period of time where the economy was growing at 2. We're doing 10 percentage points of return above the growth rate of the economy. And that was because of $45 trillion worth of liquidity shoved into the markets. So the thing to think about going forward is what happens to those returns if you don't have another $45 trillion worth of liquidity shoved into the market from TAMP, HARP, HAMP, all these different programs, bailouts of banks, stimulus checks, QE program, 1, 2, 3, 4, 5. What happens if those don't come back in the future? Earnings are going, those rates of return are going to have to come down substantially over the next decade.
Yeah, and this is where I think people, talk about like the lost decade potential for stocks, right? And I got to go back to my consensus view of what could happen next year. A lot of that from the experts that have been appearing on Wealthion is largely driven by assumption of a Fed pivot at some point in time. So to your point, Lance, like if we don't get the same kind of market support from all that stimulus and liquidity, forced liquidity that we've had for the past decade, then all of a sudden what we just talked about could go out the window and we could be talking about things just languishing for an awful lot longer. So that's one reason why we'll be doing this every week next year. All right, so just one last part about this great article that you wrote. So you have a great chart in here about how asset selection styles rotate with market cycles, which is sort of the seasons element of the gardening, right? And you have some great, analogies. Okay, financially, this is how you prepare the soil, and this is when you plant to the season, and you water and fertilizer and all that stuff. People can go read the report to get all the details there. But can we just talk about this asset selection style rotation? Because that's really important, because it really is kind of a guide to say, oh, if you can figure out where you are in the season, then the strategy makes a lot of sense, right? Just like you plant your leafy greens at a different time in your garden than say you plant, corn.
Right. Yeah.
Or tomatoes.
Well, yeah, absolutely. Hey, look, let's, I just want to touch on the article just real quick, because it's important to, when you start talking about the seasonality of what goes on. So again, yeah. So go to realinvestmentadvice.com. Just it's on our front page right now. But what we kind of talk about is that there's a lot of similarities between managing your portfolio and managing a garden, right? And so if you garden, you'll completely understand what I'm about to say. If you've never gardened, because like I have no green thumb whatsoever, and it's not because I can't garden, right? I'm lazy about gardening, right? So if you want to be a good gardener, it takes a lot of work to grow a garden. You got to, you go till the soil. You got to fertilize the soil, you got to plant the seeds, you got to water it, you got to be patient, let it grow, but then you got to weed it, right? If you don't weed the garden, that's selling your laggards and losers. then the weeds will just take over your garden and you won't have a garden anymore. And weeds will do a very good job of that. The other side of it is if you don't harvest the bounty, right? So you plant the garden, you tend it, and it grows fruit. If you don't, harvest that, your tomatoes, your carrots, your peppers, whatever you have, they'll just rot and they'll go back to the ground and you didn't get anything out of it. And this is what happens in portfolios, and why this is so important is that, I can't tell you how many people I meet, they go, oh, let's go back to Tesla. Great example of this, right? People were buying Tesla a couple of years ago. I was like, I'm never selling Tesla. Tesla's going to the moon and it's never coming back again. And now they're down 70% in it. And what we talk about regularly, and when we talk about what trades do we do this week in our portfolio, the majority of the trades that we make half the time is trimming positions out of the portfolio. And we're
it's the weeding, it's the
and we're selling losers that we don't like, or we're reducing them to a position size that we want to maintain longer term, or we're taking profits when they become overweighted in the portfolio as well. And that's just that part of that harvesting process. But that way, when you have a big correction in the markets, you retain some of that bounty that the portfolio generated, rather than just letting it kind of revert back to the earth, which is what happens to passive investors all the time.
Yeah, no, so that's exactly what I want folks to understand here. And look, I may be a little bit more of an experienced gardener than you, Lance.
You are. If you've ever grown planted pot, you have more experience than me.
Okay. But by no means am I like a very great accomplished gardener. But I used to, my prior job before Wealthion, we used to talk about personal resilience and the importance of owning a garden. And I moved up here to the country and had the garden and the chickens and the pigs and everything, and it's all wonderful. But when you start off your gardening career, you're really spending the first couple of years just learning how not to kill things.
Yeah.
Right? It's so easy to not grow things well or to kill them, right? And so you're just trying to learn how to kill them a little less aggressively as each year goes along, right? And there's something about that with an investment portfolio, especially if you're early on in your career here, right? You shouldn't start in with just like you shouldn't start a backyard garden thinking, oh, my family, this is going to provide all my family's calories. Absolutely no way. You when you start a garden, you realize how many calories people need to survive, and unless you've got basically a small or larger farm in your backyard, you're supplementing your table, but you're not going to be living off this thing year round. So similar, like as an investor, you shouldn't start and say, okay, I'm going to double my portfolio in this year, right? It really just should be learning the basics and getting good at them, right? And then over time, that the benefits of that compound, and then hopefully within a couple of years, you're a good investor or a good gardener, right? All right, great. So just before we get off this topic, because I want to put up this chart here, Lance, can you just speak briefly to this asset selection styles rotation?
Yeah. So what this chart shows you is it's kind of busy, but what it shows you is there's an economic cycle, and then following that economic cycle is your investing cycle. Because again, markets, will lag a bit as we start coming out of a recession, and your growth stocks will start performing better. When you get to a peak of the economic growth cycle, growth will start to underperform, value will begin to outperform, and at the bottom of the trough of the recession, that's where deep value investing really starts to perform better. But during the actual phases of the cycle, there's also, as the season progresses between an economic recovery, an economic acceleration, and an economic peak, there are different, sectors of the markets that tend to do better, in various cycles, right? So, when you're coming out of recession, value stocks tend to perform better, but the value-oriented sectors of the economy tend to perform better. In the growth side of the market, as the economy is really starting to expand and grow, and growth stocks are really kind of performing better, that's where your growth sectors of your technology and those type of sectors are going to perform much better. So what the chart shows you is just, and again, it's not exact, it's not precise. You can look at where we are right now in the economy and go, well, I think we're in a recession, right? But some of the sectors don't quite line up just yet. So it's not an absolute basis of things, but it's just generally historically kind of how things overlay to give you a sense of, okay, back to the planting the garden analogy, right? I don't want to plant tomatoes in the middle of winter.
Right.
They're not going to work. So I want to plant, things that have a hardiness to them that can grow.
Right. Cold hardy kale. Yeah, exactly.
Yeah, because everybody loves kale.
So out here in Sonoma County, we're blessed where we can grow pretty much year round.
Yeah.
And they have CSAs, which is where you subscribe to a farm's output. You get a box every week of what they grow. And the farmers here, they all call the winter basically that's the period of 50 shades of kale. That's what you get during that period.
Great. Remind me not to order from California. But look, and you made a really good point earlier, and just last thing, and then we can move on, is that when you're starting your investing cycle, the big mistake I see everybody make is they're like, okay, I'm going to buy stocks, right? I'm going to buy these stocks. I'm going to double my money, like you said. Look, step one of becoming a good investor, and this is what Adam said a second ago. It's the same way with becoming a good gardener, right? Trying to figure out how not to screw things up is really the most important thing. So first thing you want to do is learn how to save. I'm going to put away $50 this month. You're not investing anything. Just put away $50 this week or this month or whatever it is that you can save, and train yourself that every month I can put that money away. That may take you a year just to figure out how to save, because if you can't save money, that's your fertilizer, by the way, then you can't grow a garden. And so once you can save up a nest egg and you're in the process of being able to continue building cash flow from your savings, then you can start to invest. So when you invest, don't go out and start trying to plant the most difficult plants to grow. Start out with the really basic stuff. In the investing world, that's ETFs. Buy an ETF of the S&P 500. Watch it go up in price, watch it go down in price, and figure out why is it going up in price and why is it going down in price. Figure out how the market works with something very simple. We used an automobile
analogy, yeah,
previously, right? Don't try to build the car from scratch. Learn to drive the thing first, and then you can figure out how to work on it. But start out with ETFs, and then once you figure out what's driving the markets, what makes it go up, what makes it go down, then you can start exploring out and expanding on your portfolio using individual equities. But give yourself 4 or 5 years to figure that out. It takes time. The big mistake that most people make is they jump in thinking that they're smarter than the markets. And 2020, 2021, everybody was smarter than the market. You really weren't. It was just the stimulus was making you appear really smart.
Right.
And now that's over. So, we find out how smart we really are. And that's, but you can invest in any market, you can make money. It's just, you have to be disciplined about how you do it. And that's why gardening is such a good example, because gardening is a very disciplined activity. If you don't fertilize regularly, if you don't harvest regularly, if you're not planting regularly, if you're not, weeding regularly, you don't have a garden for very long.
Right. It all goes to hell. Right. All right. Got other points I could say on this, but I think we've expressed the biggest part of the value, and we got more things to go on. I'm going to jump over real estate and jobs this week. As we normally do sort of our recession watch. The only thing I'll say is there was a tweet that you put out that was sort of symbolic of a lot of discussion I've seen recently of a lot of listings that are getting pulled and then put back on the market. So instead of having to do, having a property that's on for a lot of days on the market and you can see the price declines, people are pulling as opposed to having to do those discounts. But you're seeing more and more of them come back on the market at a lower price, get pulled, come back on the market as a lower price. And so these are just some of the games that we see these folks try to play to make it not look as bad as it is. But
when I was selling my house, I did exactly the same thing. We didn't want to have the house showing as, being listed for more than 3 days, because at that point in time, houses were flipping very quick. And so we'd list the house for 3 days, we'd pull it, list it the next day at the same price, and it had a brand new listing. So the point of that tweet that I put out is that, it's trying to make the case that, the housing market's still pretty healthy because houses aren't being listed for very long before they sell. But the problem is everybody's figured out this game, and we're
Right.
watching houses, and as I told you, we've been kind of just idly looking for properties, and we continually see them. It's like they're listed and they're gone. They come back a couple of days later, and the day count is zero. And so and again, I don't know how the algorithms work at the Redfin or whatever in terms of the number of listing days, but if they're not capturing that, it's going to make it appear that the listing time is a lot higher than probably what it, or sorry, is a lot lower than what it probably is.
Yeah. So anything that Lance and I could really dig into in the time we have here on real estate, you're going to get a much, much deeper dive if you watch the video that we released on Wealthion 2 days ago with housing analyst Nick Jurley. If you haven't watched it, I'll put up a link to it right here. But kind of the punchline is, Nick's one of these guys that just tons of data about what's going on, but has been ringing the warning bell for the whole year that big housing correction was headed our way, and he's now saying it's now no longer academic, folks. It is in process, and he's got a bunch of data that reinforces that. So if you're interested in the latest on what's going on in housing, you got an excellent deep dive into it with that video. All right. Last thing before we get on to our main and closing topic here, Lance. So I've got some good friends in the content generation business who are writers and whose businesses is supported, at least in part, by Patreon. And for those that don't know what Patreon is, it's basically a way for you to support content producers that you like. It's basically kind of an ongoing giving program. Think of it like kind of a continuous GoFundMe, where the author says, hey, look, I want to write this blog or I want to write this book, but I don't make a ton of money at it. So if you want to help me, stay afloat so that I can afford to do this, please give me anything from $1 a month to whatever, right? And there are people that this is a material part of how they fund what they do. So I've talked a lot with a good friend of mine who's on Patreon, saying that, hey, let me know when your Patreon subscribers start to weaken. Because to me, I think this is going to be an early canary in the coal mine from a recession, consumer tightening their pocketbooks standpoint. Because look, everybody wants to be charitable and giving, but once things start getting tight enough, you just have to say, look, charity starts at home. Like I'm kind of going into self-preservation mode here. So probably the first thing you cut are these discretionary, charitable giving elements. Especially if it's not to a real charity, but it's just to, a writer. And surprisingly, up until recently, he's continued to grow. He's like, yeah, I would have thought I would have seen some weakness, but it hasn't happened yet. Well, now I just got this from him. Said, I've lost about 10% of my patrons in the past 2 months, yet my position in both writers and finance advanced 1 place. That erosion's pretty severe. And I would have expected to drop 5 to 10 positions. The fact that I actually picked up a position tells me that everyone else around me also lost 10% of their patrons or more. This suggests the long-awaited evidence of belt tightening may very well have arrived. So this has just been an early warning indicator that I've been watching, honestly, folks, for a couple of years now, that finally is beginning to blink red. That like, okay, we might be seeing people begin to tap out here and they're giving. So anyways, I just thought that was interesting. Anything you want to say on that before we move on, Lance?
No, I think it's a very interesting point. One thing I've kind of been wondering about for a while is like, GoFundMe, programs, all these, like Patreon and all these different subscriber services. And then you think about every time you want to read an article, right? Washington Post, New York Times, whatever, you got to get past the paper. If you want to watch something on television, you got to subscribe to some channel. And my question has been now for a while is when, and this has all been fine, right? As long as we're sending checks to households, everybody's got plenty of money to spend, it's all good. And one of the questions that I really have is when the kind of the rubber hits the road and people go, I've got to start cutting stuff. Where do they start cutting, and how many of these, because people are just getting feed to death, right? I mean,
Yep.
Once everything you want to do, it's a subscription. You got money going out the door left and right. And, I'm just curious at what point that a lot of those subscription services get cut off.
Yeah, let's try to find some of that data and look at that next time around, because I think we're close to there. You and I have talked about how food price inflation's gotten so crazy that like eating out, people are basically just increasingly just tapping out of it and saying, look, I'm willing to do it, but once you get, a hamburger at $25, I'm out. I'm just not going to do it anymore, right? You're talking about the subscriptions reminds me, last time I went out to Chicago, Illinois is a train wreck in terms of the state's finances, right? And so they're just trying to get money wherever they can. I went from Chicago to Wisconsin, which is like an hour drive. It's not that far. And I almost lost count of the tolls I had to pay along the way.
Yeah.
Like I literally was just on the freaking highway. I had to get off once and I had to get off the highway, I had to pay to get off the highway. And I like filled up with gas and then I had to pay to get back on the highway. It was just nuts. I mean, it was literally like, I want to say like 8 or 10, little tolls I had to pay along the way. It was just bananas. And it sort of feels like that's where we're going content wise. You want to look at anything? Okay, great. Take out your pocketbook.
Well, Washington Post, again, look, you can say, well, it's because of their content, or you say it's because of their views or whatever. They lost 500,000 subscribers. I mean, that's not meaningful, right? But that was kind of that first shot across the path. I'm going to start cutting subscriptions. What can I live without? Well, I can live without the Washington Post because I can pretty much get news everywhere, right, for free, just by reading Google. So, but that's the stuff I'm kind of watching because I am very curious as to where, like with the Patreon story, like where do people really start to batten down? Like, I'm still going to buy food. I'm going to buy gas. I'm going to make sure my kids have clothes. Can I live without Netflix? Can I live without Disney Plus? And that's really, I'm really interested in the streaming, kind
Space.
of, right? As what happens there, because again, content isn't great. It's okay, but they're having to produce so much of it so quickly. I mean, what was the last really great blockbuster movie that came out other than Top Gun Maverick, right? So, but it's just they're having to put so much content out so quickly. It's not great content. It's okay content. And I'm just curious at what point do people go, it's really not worth the $15 a month or whatever. I'll just do something.
And the fact that most households right now have multiple ones, right? So when you start getting tight, you're like, all right, look, maybe we won't go to 0, but do we need 7? Maybe we'll just break down to 2, right? Exactly. So we'll see that. And on this content side of things, I just want to very gratefully thank everybody viewing here. We just passed a big milestone yesterday here on Wealthion. We did hit our 200,000 subscriber milestone, folks. So thanks so much. And I do think, Lance, that we are benefiting right now from this dynamic that we're talking about. I mean, we're hopefully putting together compelling, financially nutritious information here that's worthy of our viewers' time. But I think to your point, that they're not getting the quality as much. We haven't talked so much about how the quality has come down a lot in a lot of these spaces. But obviously, if you listen to people like Matt Taibbi and a lot of these journalists that have gone independent, they will tell you firsthand about how the industry has really devolved since they started their careers there in terms of the quality of the journalism that's being put out. But also to your point, everybody's getting nickeled and dimed now at a lot of these major media sites. What's nice about Wealthion is it's free, and we're going to try to keep this content model for free for as long as we can, and I don't see any reason why we can't. So hopefully, we're seeing sort of a renaissance in parts of the media space as new models like this one, come out, and who knows, maybe we end up outperforming the other guys. Of course, I'm biased, and I've got some hopes around that, but of course, we got to earn it. So we're gonna keep doing what we're doing, folks. All right. So in our last section here, Lance, let's dive as much into this topic as we can before we wish everybody happy holidays. So we've talked about this a couple of times, so I don't want to overly repeat things here, but I had an interview on this channel about a week and a half ago with Nicholas Eberstadt, who wrote the book Men About Work and has been chronicling the increasing quiet quitting of millions of able-bodied prime age people of working age in America who are just checking out. And this is not an America only phenomenon. He just focuses on that as a researcher. And it's super toxic for these people individually. It's super toxic for society. And we've had this discussion in the wider topic of over 100 million Americans of adult age are not considered as in the workforce or going to be in the workforce. And that's just an increasing drag on our society of having a huge chunk, and 1 out of every 3 basically adults just not working. And there's good reasons for a chunk of that cohort. Some of them are too old, some of them are still in school, some of them are in the military, some of them are stay-at-home parents. But there is a large and growing chunk that from a societal standpoint should be contributing who aren't. And there's lots of reasons for that. And I've had a lot of people engaging in the comments about this, some very supportively, some less supportively and angry because they're in that cohort and they're trying to explain why. Let me just list a couple of reasons for the challenges that these workers who are quitting are facing or feel that they're facing. One is that real wages have been declining forever. That's been exacerbated by the inflation that we've had here recently, and the cost of living has been, going up for a long time. But that's had kerosene poured on that fire with what's happened post-pandemic. A lot of people want me to make sure that I blame the Fed for that, and folks, I really do. So trust me, nobody blames the Fed more for that stuff probably than Lance and I, and I've got years of railing on that. But they've got that, hey, it's just harder to make a living, right? We're not getting paid as much, or purchasing power of what we're getting paid is declining, and costs are rising even faster. And so we're getting squeezed, right? There's talk about a toxic environment here where workers are treated disposably, and they get poor benefits or no benefits, and they just feel like they're basically a tool that's being used and discarded when it's not willing to perform at unreasonable pace or unreasonable hours or unreasonable demands from employers. And I get that happens a lot. We hear stories of Amazon forcing drivers to pee in bottles because it won't give them time to get a restroom, that type of stuff. A big topic that I've talked about for years and years and years that I think is really important to just note here is still the incentive, or I would call it the malincentive, that employers have had and still have to outsource and to automate, and that we are increasingly removing the lower rungs of the employment strata. So it's just, there used to be a lot of summer jobs for teenagers and entry positions for people who could work in those positions for a year or two and then get promoted and begin to get up to the point where they can be paid a wage that they can raise a family off of. Those jobs have been getting taken away faster and faster over the years because of cost-cutting measures, and outsourcing has made that really easy. And automation, of course, once you invest to automate, those jobs never come back, right? So we're eroding that part of the opportunity set. Got a lot of comments about this, and I'm not saying we have to agree with all of these, but I'm just saying that this is the voices from this cohort. This is what they're saying. A lot of the men are saying, look, we're just getting kind of crapped on all the time. We're getting passed over for diversity reasons. We're being told from birth, entering the school system, that we're the problem, that they're the evils of the white patriarchy, and we're representative of that. But hey, we're just guys trying to make a living here, but folks don't want to hire us. They don't want to promote us. And they're just basically, telling us that we're the devil. And a lot of these guys are like, understandably, that erodes their happiness and their sense of self-worth, and they just eject after that. Again, people don't have to agree with this, but part of the theory here is that there is sort of the snowflake factor, right? Which is that after a generation of helicopter parenting, people don't want to put up with the hard knocks and the stripes you got to earn by joining an organization at the bottom of the rung and do stuff that's not sexy, and have to do, menial work for a while. And, you get the complaint against the millennials. I'm not saying it's true. It's just sort of a stereotype of, hey, the guy quit because we didn't make him CEO, by the second month at the company here. So there's a bit of maybe a mismatch of expectations with a lot of these workers going into the workforce right now. Incarceration and addiction is a really big problem. I won't go into that in depth, but Nicholas in his work goes really deep into that. And then maybe the other really big one here is that state support programs have honestly really raised the bar in terms of how much you have to make at a job before it equals the benefits that you're getting from not working and receiving state benefits. And I was looking for an article. I'll see if I can find it by the time we edit this video. But it was showing that in certain states, you have to be in a job that's paying you $80,000 a year. I think there was one or two states where it was $100,000 a year before you were making enough money to enjoy the same benefits and overall value that you would be getting from being on state support in those states. So understandably, a ton of people are just like, why should I go back to work if I'm going to get a job that probably is going to pay me a lot less? So I'm going to get less money and I'm going to have to work, versus I just get to stay home and I get to cobble together all these different support, programs, and I can actually live pretty darn well. So anyways, it's a long series of challenges. I don't want to, rat hole in any individual one of them, but I just wanted to say it's a very big multifactorial program. We're going to get to the solutions in a second, but Lance, anything you want to add to that soup of challenges?
Not really. No, I mean, it's look, I have a lot of personal opinions about it. I raise my kids in a certain manner. They will not be, one of the 50% of millennials living at home with their parents.
Yep.
And so, look, my bottom line is, I listen to a lot of these people on TikTok, right, that are complaining about capitalism sucks and I can't get it. I don't want to work because, it's why should I work at this job and make, minimum wage and all this. And I get it. Right. I get it. I went to college and I got this degree and now I can't get a job that pays me anything with it. What degree do you have? Right. So, I mean, we have all these choices. I have all this student debt. So, it's another problem. I get it. We all make choices, and the ability to participate in the capitalistic system is there, but you've got to be willing to sacrifice, work hard, take advantage of it, and grow something. I mean, for every person, for the 7 million people out there that are complaining that capitalism doesn't work for them, there's 7 million immigrants that have come here to this country and have built very good lives for themselves. But, they're working construction. They are working at fast food. You're talking about, one of the big problems that we have for kids coming up, and this was a big challenge even for my kids, because I make all my kids go to work as soon as they turn 16, is getting a job. Because a lot of the jobs that they would normally get, that like you and I had growing up, mowing yards, washing cars, those type of things, are done by, quote unquote, a lot of illegal immigrants that are here. And, and that's okay. I'm not, bashing illegal immigration or anything like that. I'm just saying they take a lot of those jobs. And, one of the best examples of that culture and the difference between that culture and our culture, as an example, is Greg Hayes, who was the CEO of Carrier Industries right after Trump was elected. Carrier moved one of their plants from Mexico to Indiana, and Jim Cramer actually interviewed Greg Hayes and asked him. He says, "Okay, well, why are you moving this?" It's like, "Well, we're moving the plant because our company Carrier, and at that time it was United Technologies, is owned by United Technologies, which has a massive number of government contracts. And we want to make sure that we stay in favor of the government," i.e. Trump at that time, who was promoting, bring back jobs to America. Yeah. Says, we want to stay in favor with that. So we're going to move this one plant from Mexico back to Indiana. We're going to get $70 million worth of tax credits, and we're going to automate all the jobs in the plant. And he's like, "Well, why are you going to do that?" He says, "Well, because the problem is that the workers in Mexico, they work for $5 an hour. They work 12 hours a day. They don't complain about benefits. They don't complain about vacation time. They don't take times off. They work 6-7 days a week. and they show up to work regularly, and they work hard, and they do a great job. And we don't have to really just stand over and supervise them every 5 minutes and pat them on the back and say, hey, what a good job you're doing. They show up, they work, they get their paycheck, they go home and take care of their families. Says we can't get that in America, right? That work ethic does not exist in America. And this is why when you take a look at construction crews for houses, my wife, her company, they have truck drivers that drive propane, well, actually liquefied natural gas from one place to the other. Every now and then she'll get a call from a truck driver saying, hey, I need 2 days off. And they're like, well, why do you need 2 days off? He says, oh, I'm going to go build a house. I'll be back in 2 days. And he'll take off for 2 days. He'll go build a house and then he'll come back to work. So, it's just, they don't quit working, right? They work, and they have a very strong work ethic, and that's their culture. And that's the one thing that we've forgotten, I think, as a generation, because we started this whole Dr. Spock helicopter parent thing in, the 1980s. And, we're not going to discipline kids anymore. We don't want our kids to work. And, it's like, we need to coddle them and all this. When I was growing up, I was a fast food worker at the age of 13 at the country club where my dad was teaching tennis. He got me a job there to wash dishes and flip burgers. I was 13 years old, but outside of that, I was mowing lawns and delivering a paper route. A paper route is a great job for kids. It teaches them to manage a business, teaches them to collect their money from their customers, et cetera. It teaches you so many skills, but nobody wants to do that anymore because we're afraid that if our kids are riding their bike delivering papers, they're going to get snatched, kidnapped, whatever. And, we're so petrified as parents to put our kids out there and let them get exposed to the world because we're afraid of all the bad stuff that might happen to them, that we've kind of fostered this shelter mentality for a lot of people that I think is hurting them.
All right. So I'm going to interrupt you there for two reasons. One, agree with almost everything you're saying. I went through that long list of factors to show that it's a multifactorial thing, right? And I think that there definitely are cultural, there's some cultural regression we've done that we just need to say, hey, look, we got to get, or maybe cultural, we've gone off the rails a little bit, and we need to go back to maybe what worked in previous generations. But they're all also just, they're real realities. Like it is tougher. It is tougher these days as a kid, as a younger person, or even an older adult. The payoff between wages and cost of living harder, right? So those Mexican guys, yes, they've got much more better on average work ethics and appreciate the value of work hard, but also you can get by with less money in a place like Mexico than you can, say, in a lot of places in America.
I'm talking about they live here, right? They don't live in Mexico. They live here.
Oh, I thought you were having the carrier CEO compare that. Okay. Anyways,
that was just the one example though about, getting, good quality employment here and people that'll show up and work and have a work ethic and work the way up in the cycle. Right. That's what Greg has says, is we can't get that kind of worker. We need that kind of worker. But no, I mean, how many landscapers do you have? Look, I have the landscaper that works on our street where I live, right? He probably services every house on this street. He pulls up in a brand new Dodge 3500 Ram, fully decked out. It's probably an $80,000 pickup truck, brand new trailer, mowers, the whole 9 yards. I mean, this guy makes a lot of money. Landscape yard, doesn't speak a lick of English, right? You cannot if you don't speak Spanish, you cannot communicate with him, but he does fantastic work and he shows up every week.
Right. Okay. But this is an important point. And then I want to get to the solution part here, but it is, again, there are some real challenges that are different these days, right? So like as a kid I used to mow lawns when I was 14, that was my first business, right? Odd jobs, right? I couldn't compete against that guy now, right? Because landscaping has been kind of professionalized, right? So that guy's got his truck, he's got every blower and raker and mower known to man. Like a 14-year-old with a crappy little push mower can't compete with that guy anymore, right?
That's exactly my point. Those jobs, like with my kids, they couldn't get a job at 16. We had to manufacture jobs for them at 16. And we worked with friends that would hire them because of child labor laws. That was one thing, right? Most jobs you can't get a job until you're 18.
Yeah.
But two, the typical job, like I was saying, washing cars, lawn mowing, those type of things, it's not available anymore because those jobs are gone to other people that have professionalized those jobs. babysitting you can still do, right? So, my kids
Yeah,
still
for now, but yeah.
yeah. But yeah, no, that's exactly the point, is that, the jobs that used to be available to you and me are no longer available to us because of changes in society and what people have come in and where jobs have gone, and a lot of jobs have been automated. There was a great video out just this past week. It was out in California, and this girl is making this comment. She's like, well, there go the jobs at McDonald's. And it was a McDonald's that is now fully automated down to the delivery window in the drive-through, completely automated. That's basic economics. When you raise the minimum wage to $22 an hour, that's what's going to happen to those.
That's how they survive. Exactly. Yeah. And that was my whole point about automation and outsourcing.
Yeah.
Okay. So let me yeah. All right. So let me drag it into solutions, because really what I've been building up to here, which is like, yeah, it is tougher, right? Like I'm being real honest with that. I'm not trying to sell sunshine, right? It is tougher. And if you're a parent of kids, your kids are going to have a tougher time than we all did, right? But it doesn't mean that it doesn't mean that quitting the game is going to help you here, right? And that's what these people are deciding to do, right? Which is one reason or another, I'm just quitting it, right? And as Eberstadt said, most of these people are either getting on disability somehow, and some are doing that, and then the rest are doing basically just living off of parents or girlfriends and boyfriends or spouses, right? So that's not a sustainable plan, economically, right? And so if you are, I kind of go back to the whole lottery motto of like, you can't win if you don't play, right? If you quit the game here, you're not going to win in terms of having the type of life that you want to have. So yeah, the deck is stacked against you, but I just see that as all the more reason to have to really lean in and fight for your future prospects here, to take charge of your destiny. And get a number of quick things I want to bang through here, Lance, and I'm sure that you've got other comments as well. One is, we're so relative in how we measure success. One of the reasons why these people eject and then have very high reports of depression is because they're comparing themselves to the world around them, and largely through the lens of social media, right? So I'm seeing my friends post their perfect lives, and I'm following these influencers who are on Gulf streams and drinking Cristal and whatever, living this Kardashian lifestyle that I just feel so far away from, that I just give up because I feel like I'm never going to get there, right? And the right thing to do is to just not get distracted by all that and realize the only person that you have to compete with is yourself, and ideally yourself from yesterday. So Jordan Peterson talks a lot about this, where he says find the one thing that you can do today to make yourself today just a little bit more marginally better than the person you were yesterday. And he sort of famously says, hey, start your day by making your bed, right? Like at a minimum, if you didn't do that yesterday, that's one thing that's productive that you've accomplished today. And then you'll do that tomorrow, and you'll find one more thing to do, right? And eventually, what the theory here is that type of behavior compounds, right? And it's, of course, not just making your bed, but it's like, well, apply for that one job, or spend some time today thinking about work you could be doing that you would be a good fit for that you aren't today, right? But it's developing that mindset of self-improvement, and that you have control over your own quality of your own state of self-improvement, and that you have the ability on a day-by-day basis to keep ratcheting that up higher. The other thing I'll kind of tie into that is, this whole process, really, the success of it starts in self-understanding, right? It's understanding kind of who you are, what your strengths are, what your weaknesses are, what you're a good fit for. And then once you have a good enough sense of that, plus, kind of what success in life looks for you, then you start looking outward in the world and saying, okay, for somebody who is wired like I am and has the collection of abilities and strengths and interests that I do, what is the possible opportunity set, right? Because once you do that work, you then be able to start focusing on targets and goals and particular destinations. And, as you and I have railed about, Lance, our schooling system doesn't do that. I've talked a bit in this program before about the book that I'd written on this that goes sort of through in detail on a lot of different tests and exercises and stuff that you can put together. We talked a little bit about the Johnson O'Connor test. Like, there are a lot of things out there that can help you get this self-understanding that once you have, it doesn't necessarily answer, everything for you. It doesn't necessarily say, Lance, you need to be a financial advisor, and that's what you got to do with the rest of your life. But what I think it does is it gives you the compass points that you can then navigate the world by. Okay, there's this set of work out here. Let me look at myself and how I understand myself. You know what? Bad fit. Let me not even worry about that anymore. But over here, this is a good fit. Let me direct my energies that way. So I'll pause for a second here, Lance, but does this sort of, mindset of self-improvement and starting in self-understanding seem to you like the right place to start here?
Well, yeah. And again, this is what I was saying before, at the outset of all this, which is, the capitalist system is there, right? And you can take advantage of it, but you've got to be willing to do it. And that starts with, developing a skill set or, figuring out something that you can do that you can build a business off of. And that's how wealth is created. Yeah. If your whole outlook in life is, I'm just going to get a minimum wage job, and then yeah, it sucks, right? I mean, it's going to be very hard to make ends meet with that, but and it's not going to seem fair. And if you're just going to go work an 8-to-5 job with some company and just be kind of a cog in the wheel and not really dedicate yourself to the job and try to work your way up in the company, you're just going to, like what they call now quiet quitting, right? I'm just going to do just the bare minimum.
The bare minimum, yeah.
Yeah, and that's fine. And that's your choice, right? And Adam, you said earlier, is like, it's a lot tougher today. Well, it is tougher, right? To have things, but we also have a very misplaced perception of what a living standard should be. We all think that it should be like on Instagram, where I'm driving a Ferrari, living in a $4 million house, and I've got a a Gulfstream sitting at the airport for me. That's not normal. What you see on Instagram is not a normal life, right? That is not what most people, the vast majority of Americans have. 98% of Americans live in a 2,800 2,000 to 2,500 square foot house, 1,300 square feet house. It's not these massive multi-million-dollar mansions. And so you've got to start kind of getting your expectations in line with some reality about what is my basic living standard. I need an apartment. I need a car that is not a Ferrari, but I need a car that gets me from A to B. I need to put food on the table. I need my phone, so I can work, those type of things. And there's a basic lifestyle that you need to earn money for. And that's achievable and doable just about any level. And if you want to excel beyond that, that's where it's going to take work and effort, right? And this is what Mike Rowe was talking about when Mike Rowe was recently talking about the 7 million people that are sitting outside the labor force that have mysteriously dropped off the face of the earth and that have just kind of quit, right? He's like, look, he says, you have to be willing to work, and you've got to be willing to put in the time in order to achieve success. And if you're not willing to do that, then yeah, it's not going to work out well for you, because that's not the way capitalism works. Capitalism doesn't reward laziness. Capitalism rewards effort.
Well, and also on that point, and I got a number of things here that we'll get into in a second here, but is the value of work, right? So that's what Mike Rowe was really talking about too, which is Eberstadt said, look, we're having this experiment right now in universal basic income, right? We've got these millions of people who basically their income is being provided by others, and they've got time. What are they doing with it? Not much, right? They're spending a ton of time on screens, a ton of time at home, and they've got very high reports of depression, right? And so, what they're missing is this sense of purpose and contribution, right? So the path to the destination that you and I are talking about, which is a full, rich life where you can afford the things that you want to have, in life, that's work is the pathway through there. But what I think too many people don't necessarily focus on is work is a reward in itself, right? It gives you self-confidence. It gives you a sense of self-worth. It gives you attribution, gives you purpose. And that's a huge part of the equation that I think a lot of the people that are checking out are ignoring, probably because they haven't been taught it, maybe because they haven't had real experience with it. But it's an important part of the human condition. I mean, I'm not going to call it work as much as I'm going to call it having purpose.
Yep.
And we get into that in a moment, because at the end of the day, to your point, Lance, you have to be really serious about what you want in life, right? And is what you want in life truly a Ferrari? Is it truly a home in Malibu? I mean, those are all nice things to aspire to, right? But is that what you really want? Or do you want to have a happy, fulfilled life, right? And purpose is a massive part of that, right? And what's great about purpose, and the reason why I'm hammering on it so much, is one, if you have purpose, then you're likely to perform and even outperform and achieve what you want to achieve. But also, like, there are no guarantees in life, right? Like, your purpose may not end up with bags of money for you, right? But you wake up every day with a sense of knowing what you want to do, being able to do what you want to do, and making the type of difference that you want to have in the world. And honestly, folks, when it comes to sort of like happiness and a life well lived, that's a massive part of the equation right there, right? And it seems to me that kind of what you're talking about, that value of work, like in and of itself, is something that's been really denigrated in society at this moment.
It has. I mean, look, we talked about before. If I have a lot of clients as well as friends that have labor jobs, right? And they're electricians, they're plumbers, they're welders, pipe fitters. They're as happy as they can be because they make a really good living. By the way, they make six figures.
That's the whole millionaire next door right there. But
but they're happy with the work, and the reason is because when they go and do a job, like I have a very good friend of mine that he's an electrician. Every time I need something fixed, I call him, he comes over, he fixes it. I pay him very well for it. But it's a sense of accomplishment. When he makes it all work the way I want it to work, he can step back and look, I did a job, right? And there's a sense of accomplishment and fulfillment. And he is so happy with his life, right? He does his job, he has a sense of accomplishment at work. Then he goes home, he's got 3 kids, he's got a beautiful wife, and they have a very good life that they live together. They don't live in a massive house. He doesn't drive a Ferrari, right? They do okay, right? She doesn't work. So basically all he makes is supporting the family, and it ain't cheap to raise 3 kids. I'll attest to that with 4. But, he's very happy, right? I mean, he doesn't wake up and, doesn't begrudge going to work every day because he does something he enjoys. And there's that old saying about if you do something you love, you'll never work a day in your life.
Right.
And and it's very true. I love what I do. And people ask me all the time, it's like, I want to do what you do. I was like, no, you don't, because I work 18 hours a day, and it's 7 days a week. And fortunately, I have a wife and kids that support me in what I do. And they allow me to do it, and they understand that what I do is what provides the lifestyle that they want to have, and that they get to enjoy things like we're going to go skiing next week, and they're very happy about that. But they understand it's a function of the time I put in. And so people go, Lance, I want to do your job. It's like, are you willing to work? I'll give you a really good example, right? We're trying to hire another certified financial planner to work at our shop, right? And we've interviewed a bunch of them. And you know why we haven't been able to hire one? Because we tell them that their work week will be 70 to 80 hours a week, and they don't want to do that.
Yeah, I actually get the same issue with Wealthion. We're trying to bring on new talent that can help me out here. And tons of people love the idea of being in front of the camera and having discussions like this. But when we talk about all the work that has to go in to make that happen, the 70, 80 plus hour work weeks, and the fact that it's all going to get done tomorrow. So if it's not done at 10 at night, well, you got to stay up till midnight to get it done, right? That type of stuff. And they just disappear at that point.
Yeah, exactly. And it amazes me. I mean, we're talking about, very good income, like not just good income. We're talking about very good income, and they're not willing to work for it. And again, maybe it's anecdotal. Maybe it's just the 10 or 12 advisors that I've talked to that don't want to put the work in. Maybe there's a guy out there willing to put in the work and the time. But if you want to make, a very good 6-figure salary, I got a job for you. right? You need to be a CFP, you need to be an advisor, you need to understand what's going on, and you'll be willing to work a lot. If you're willing to do that, you can make a very good 6-figure salary with benefits and do well. But I can't find anybody to put in that time, that wants to put in that time, because again, they've got to sacrifice everything else in their life to do it. And it's just, that's the type of work it requires. But if you're willing to do that, you can build a lot of success.
All right. Well, hopefully maybe there's somebody watching right now, Lance, that fits that mold and they reach out to you and your problem solved. Yeah. Real quick, just in the interest of time here. So, what I sort of wanted to do with this discussion was to get to some like concrete things that people could do right here that are facing this. And we've mentioned a couple here already, right? Which is develop the right mindset, develop that self-understanding. You talked about, getting experience, right? And one thing I just want to say on that is totally agree. And free work might be your best return on investment here. Right. So in other words, if there's an industry you want to break into, a company you want to break into, and especially if you don't have prior experience doing it, being able to go and say, look, either I'm young enough where I can burn, a month or two working for free for you and I can couch surf and whatnot, or if you're older, say, look, I'm going to finish my job, but then I'm going to give you X hours, later on in the day of free, hard work. So in my experience, Lance, like I have personally have never gotten a job just by submitting a resume, and almost everybody I know who has, particularly in today's job market where everything's now automated in terms of the hiring process with zillions of resumes going in for every open position. I think if that's your strategy, it's not a surprise that so many people give up by saying, look, I put my resume out at a bunch of different companies, nobody ever got back to me. In this world, you have to do it by basically, blazing your own trail and being unorthodox, right? You've got to like literally show up at the company physically. No, nobody does that anymore, but literally do that, or find ways to get, a connection somehow in the company. In today's world of LinkedIn and all that, it's no longer 6 degrees of separation. It's probably more like 2, maybe 3 at the most, where you have to kind of create little cracks in the door for you to then get your advantage. And actually, that's how I started. That's how I got my career on Wall Street, actually, is I actually just showed up at the company and said, hey, I'm willing to work for free. And then let's see where it goes from there. Right.
No, it's the same. I have the same conversation with my kids all the time, because the world is different now. Right. And so when you go to apply for a job, it's all online. It's like, yeah, submit your application online and we'll take a look at it and we'll call you. And so my kids think that that's the whole job, right? It's like, I put the application in. If I don't hear back, well, I guess they didn't want me, I'll move on. I'm like, you can't do that. You're one of 10,000 resumes getting submitted for this job. You need to go over there and knock on the door. Go if you, when this was really kind of keen lately, because they're waiters at restaurants of various sorts, right? And so, trying to get a job in a college town, especially, either at Tech or A&M, every college kid is applying to wait tables at every restaurant, in college. And I'm like, you're going to have to go over there and find who the manager is and shake that guy's hand and look him in the eye and say, I am your guy. I want a job here and I'll do whatever it takes to work here. Give me a shot. And, they're like, whatever. And so finally convinced my daughter to go do that. Guess what? She got the job.
Got the job. Yeah.
Yeah. Because nobody else would show up. And the guy said, look, if you're willing to show up and at least try, at least I know you'll show up for work, So, but that it is hard. You've got to really go out of your way to be creative about how to get in front of somebody to get a job.
Yeah, and this is a totally nerdy reference, but the point I'm trying to make here is, so in Star Trek, there was this famous test that the cadets at Starfleet Academy would take, and I think it was called the Kobe Maru, something like that.
Kobayashi Maru.
Kobayashi Maru. Okay, and basically, I think it was Kirk was the only guy who ever won it, right? And they find out later on that the way he won it is he actually had the game reprogrammed, right? So he cheated, he hacked the game, and he won, right? And that's sort of what I'm saying here, which is, yeah, the game is not a good one. It's actually like, coded against your odds here, right? So what you got to do is you've got to break the system in a way where you're trying to claw the odds a little bit back in your favor here. Yeah, and maybe you got to go above and beyond, and maybe you've got to think outside the box and stuff like that. But in this environment, that is not a terribly fair one. You can't play by its rules, right? You got to change the rules yourself, right? All right. So real quick, you talked about I call it downsizing your cost footprint. You said, look, don't expect to live a Kardashian lifestyle, right out of the gate, but that's super important. We don't like to do it. It's not sexy. And again, this is all about beginning to kind of just be able to ignore what society, says it values and how that might reflect on you, and just say, what do I need to go in the direction I want to go in? Like, that's all you really need to be doing here. So downsizing your cost footprint, super important. Saving and investing, super important. Start putting money away, learn how to do that, develop those muscles. Once you do, start learning how to put that money to work for you. Lance has talked a lot about gardening. There was a phenomenal bit of advice that was given by Chris Brightman, who manages a couple of funds for PIMCO, that he gave on this channel. I'll find that video. I'll put up a link to it right here. But in there, he gives about 2 minutes worth of hey, here's a very simple way to become an investor. And he said, if you do this for the rest of your life, with $1,000 a month, and only $1,000 a month, even when you're making more money, he said, if you start early on in your life, you will be able to retire based upon just this plan alone. And of course, everything else that you might do on top of that as an investor adds to that and is gravy. But he's like, if you just start this simple, disciplined approach, you'll actually finish fine. So watch that if you can, or share that with your kids if they need to watch it. But in wrapping up here, Lance, I just want to say that there were sort of three things I thought were really important. We've already talked about one. So purpose, super important. That really should be a main goal. And even if you don't know what your purpose is yet, draft off to somebody else's, right? Lance, this goes to the whole like bowling alone, shortcoming of culture here right now. Like, there used to be tons of service organizations that people used to participate in America, whether it was a church, whether it was the Rotary Club, whatever. There were tons of service organizations, many of which still exist. They're now just devoid of a lot of younger people because nobody is engaging in them anymore, younger than a certain age. Those are phenomenal ways to just be in service and have the benefits that we were talking about contributing. And of course, as you do that, not only do you develop, some self-esteem and a little more confidence and whatnot, but you actually start making relationships, and it can become kind of a networking thing for you as well, where somebody says, hey, this guy's actually a hard worker. I got an opening at my company. Maybe this guy's a good fit, right? So being in service is something we've really lost, that to me is a really easy one to re-inject back into the system, especially when you look at the screen time, not only of the millions of people that have checked out of the workforce, but just the average American. So many times we're blowing on these streaming services that we could actually be donating an hour or two to our community in ways that not only enhance the community, but enhance our ability to grow as individuals. I see you nodding as I'm saying all this.
No, too. I think a guy you should try to see if you can arrange an interview with, his name is Dave Groggins. He's an ex-Navy SEAL, motivational speaker. But if you could get him on the channel, I think he would be a great, kind of a great fit to this conversation, because
I've written them down here.
Yeah, because he talks about when he was going to join the Navy SEALs, originally he went to go talk to the recruiter, and he was too overweight, and the recruiter said, you can't, we've got a standard, right? You got to have a certain fitness standard, and he couldn't run the 4 miles, and because he was too overweight, he had to lose 160 pounds. But he said, okay, I'll meet the standard. And he didn't just meet the standard, he exceeded the standard. And he says the whole thing in life is there's a standard. And if you want to achieve greatness in life, you've got to be better than the standard, because the standard is average, right? That's everybody else. So if you want to be like everybody else, just do the standard. If you want to exceed and be successful, then you've got to excel above standard. So whatever it is, whatever barrier is in front of you that is keeping you from achieving success, attack that barrier, get over it, move to the next one. I've told you, I started out living in my truck because I had a barrier, and that was the only way I could get over that barrier, was I had to save up enough money to move to the next step. And that's the whole thing in life. And the problem with most people And I'm being very general with that statement, so don't take offense. But what happens with most people is that there's a barrier, and they hit that barrier. It's like, well, I'm done. I'm stuck. I can't do anything else. And instead of focusing on that barrier, attacking that barrier, getting over it, moving to the next one, because that's all life is. And success is only a function of just getting to one barrier, getting over it, getting to the next barrier, getting over it. And that's how you achieve success. Other than that, you're going to be stuck if you don't get over the barriers.
Agreed. And that goes back to my sort of foundational point here of developing the mindset for what's possible, right? Because there's that saying, the obstacle is the way, right? Which is exactly what you're talking about here, Lance, which is it's actually tackling the obstacle head on and learning how to get past it, which is the path to progress, where so many people hit the obstacle and say, oh, obstacle, guess I'm done here, right? So it's learning that, hey, look for the obstacles, because that's where you know where to go focus your energies.
Yeah, and one of the biggest things I learned along the way was you don't have to get over the obstacle, right? You don't have to defeat that obstacle. Sometimes you can go around the obstacle by going in a direction. And where I am today is, and what I do today is vastly different than where I started. What I thought I wanted to do is not where I wound up, but what I thought I wanted to do, I didn't have the skill set for. And it forced me in another direction to where my skill set played better for me.
Better. Yeah. Great. All right. Well, look, last thing I had here was, at the end of the day, the money may come, the money may not. But the things that are going to serve you the most are the sense of purpose we talked about, health, which you and I have talked about previously. So I'm not going to go into it here. But that's obviously both physical health and mental health, and things like purpose really help with the mental health. And the third one, which I just hope we could just spend just a minute on, is connection. Right. So obviously the data that Eberstadt has shows that these people that are home alone, not engaged in constructive work, they report high degrees of depression. And a huge part of that is just because they're isolated. Right. And isolation is toxic. We are a social species. We are wired to be in community with each other and ideally contributing to each other. And if you're not, if you're checking out both from the workforce, but kind of from society in general, like I said, it's a very toxic place to be that doesn't serve anyone's interests, especially your own. And so in terms of investments here, two that are really big, but one, and I know you feel the same way, Lance, like a supportive partner in your life, right? Learning how to be a good partner to somebody and being in a relationship where you've got somebody who is also looking out for your interests and has your back and is supporting you as well. That is one of the most important life investments that you can make anywhere. I don't care what the markets are returning, right? Like that is one of the absolute best investments you can make. And so, again, learning how to be somebody that somebody wants to be in partnership with is an incredibly important skill.
No, it is. And look, it's like I said earlier, if it wasn't for my wife and it wasn't for my kids that support me in what I do, then I couldn't do what I do, right? But in turn, I have to support them in what they want to do. And this is, one of the big challenges I think that a lot of people face in relationships. It's particularly if you get into a toxic relationship, and that's, where one person is just draining everything out of you and not giving you anything back, that's going to lead you nowhere. And it's hard to get out of those relationships. But, again, the person, and this goes back to, getting those obstacles, right? The person you think you may want to be with is maybe not the person you should be with. And those can be two very different things. And, finding the person that is your person, right? That person that fits you and supports you and encourages you and lifts you up to make you a better person and, a better employee, a better whatever it is that you're doing. That's what's going to lead you to more success, because you've got to be able to know that you've got support at home, and that allows you to go do what you need to do to win the game of capitalism in whatever form you decide to take it.
Yeah, and we don't have enough time to really go into this because we're gone so over time here, and that's my fault. But what's being reported, particularly by these men that are checking out, is sort of like, look, life's not fair, and there's a smaller percentage of successful men that all the women are interested in, and nobody's interested in me. and life sucks, right? And I know that there's a certain equivalent, on the female side as well, right? And to a certain extent, yeah, there's some truth in that, right? The Pareto principle rules the universe, right? There's always going to be some people that have more than you do, but the solution is not to abandon hope, right? The solution is to say, well, how do I make myself more compelling to the type of person I want to be in, right? And Jordan Peterson again talks about this a lot, which is like, it's kind of like, you can curse the darkness or you can light a candle, right? And a lot of people say, well, there's no good people out there who are interested in me, right? And that shouldn't be the narrative in your mind. The narrative in your mind should be, how can I make myself such a compelling partner that the type of people I want are going to be interested in me, right? And begin to work on that, right?
Yeah, no, I love Jordan Peterson when he talks about that too, because it's to that point is simply saying, girl, there was a really great Steve Harvey interview, and there was a girl on Steve Harvey, and she was saying, she had a laundry list. Like, I want a man that makes money, he's got a good job, he's caring, he's loving, he's handsome, he's got 6-pack abs, he's drives a nice car, he's this, he's that. I mean, and this list just went on and on and on and on. And at the end of it, Steve Harvey looks at her and says, okay, what do you bring to the table?
Right.
And that's the key role, which is, look, yes, there are women that will go after men with money, and there are men that will chase women with money. It's both sides, right? But there are what most women want. And and this is something I learned from my relationship. What does my wife want? What makes her happy and fulfilled at home? Because when she's happy and fulfilled at home, she takes care of the house, she takes care of the kids, she takes care of me. As long as she's happy and fulfilled, she does those things. It's not money.
Happy wife, happy life. Yeah.
But it's not money, right? It's, I bring her flowers. It makes her happy. It shows her that I care, right? Her love language is touch, right? So to touch her on the shoulder, touch her on the back, hold her hand, those type of things. That's her language. Compliment her, tell her that she's pretty. And these aren't big efforts. She wants to feel safe. She wants to make sure that, there's not some financial crisis that she's about to lose her house. Safety and security are the big things with her. And as long as she feels safe and secure and loved, everything else is gravy, right? But you just have to learn that about whatever it is your partner's love language is. And I know it sounds corny, but it's true. It's not money. And 9 times out of 10, a woman will never tell you, oh, it's money. That's what makes me happy. It's always safety, security, happiness, love, affection. That's what makes them happy.
Yeah, and just a quick preview. So next week on Twitter Spaces, my wife, who's a therapist, and we're going to do a Twitter Space around all these elements of both addressing conflicts in marriages, but also the role that money and finances play, because it's one of the big 3 factors that really can send relationships off the rails. Because we're doing it because I asked my Twitter audience, are you interested in this? And demand was through the roof. So we're doing it, but all the terms you're using, like love language and whatnot, that's all from like the Gottman School of Couples Therapy. So we're gonna, folks, if you're into that at all, we're gonna dive really deeply into that stuff.
All I can tell you is it's true. And my wife has 27 personalities, so it keeps me on working.
Well, look, folks, we went way longer than I intended to here. We probably lost almost all the audience here. If you've stuck with us here to the end, thank you. What I'm trying to say, whether it's you are grappling with this challenge of meaningful work that we've been talking about here, or whether you're a parent and have kids that are, in their teenage years or entering adulthood and feeling the weight of all this, what I've been trying to express here is that, yes, there are real reasons here to say, yeah, it's tough. But it's not a lost game. And in fact, it's just, one of those realities in life where like, yeah, it's tougher. So I'm going to have to work a little bit harder at this. But with the right focus and a lot of the things that Lance and I have been talking about here, you really can shift the odds dramatically in your favor. But it really all starts with taking personal ownership. And I think maybe that's at the base of the pyramid here for the checkout factor, is that people are for whatever reason or another saying, screw it, I'm giving up here, I'm not going to play a role in this. And my point is yeah, that might get you a couch to surf on for a couple of years and mooch off of somebody or collect a disability check. But that's not a path to happiness, and probably it's not a sustainable financial situation either. At some point, that train's going to run out on you. So the pathway through here is personal agency and saying, I'm just going to have to dial things up even more, given the fact that the headwinds are blowing harder than they did for previous generations here. But the point is that progress and success here is probable if you adopt a lot of the stuff that we talked about here. So anyways, thank you, Lance, for entertaining me on this long discussion here. I hope I finally got out of my system, and we'll have different rants in the future on different topics. But I was just so moved by the plight of so many people that Nick Eberstadt really did a great job of bringing to life with his research, that I felt like, as challenging as things are, it's not a game over situation. And if folks are giving up hope, it's the wrong choice. We as a society, we need people to be more valuable. And you, everybody watching, as an individual, you have more value than to give up on yourself like that. So,
absolutely.
All right. So just as we quickly wrap up here, folks, we're entering the last week of 2023. So next week, we will have videos for you here on Wealthion. Lance is going to be out skiing with his family, as he said, but we're going to have his partner, the excellent Michael Leibowitz, step in for Lance next week. So you'll get your weekly market recap with Michael next week. I promise it will not be nearly as long as this one has become. And also we'll have videos for you through much of next week, I think Tuesday through Friday. It's going to be a little bit of the best. I've gone through and picked some of the gems of my favorite interviews that I've done yet on Wealthion to date that I think are still just as relevant, if not more so, to the environment that we're heading into in 2023. We actually have one video that's never been seen on this channel before, with somebody who might strike you initially as not intuitive for this channel, but it's one of my favorite interviews I've ever did, and it actually is an important part about investing. But I've interviewed Joel Salatin. Those of you who know Joel will know how remarkable he is. He is basically the poster child for small, resilient farming in America. He's going to talk about the investments that we need to make as a society to have a much more resilient food system. And I promise you, folks, when you listen to Joel, you'll probably want to vote for him for president next. He is one of the more inspiring guys I've ever listened to. They say in this business, never meet your heroes, because they never measure up to your romanticized version of them. I've actually met Joel in person several times. He totally breaks that mold. He is just a totally remarkable individual. It's a fascinating discussion. Definitely look forward to that one next week. So in wrapping up here, folks, if you aren't yet already aware from the many, the 50 so far weekly market recaps that Lance and I have done this year, very uncertain future ahead. Recommend that most investors navigate it using the help of a personal financial advisor who understands all of the macro issues that Lance and I have discussed to date. If you've got a great one, stick with them. But if you don't, or you'd like a second opinion from one who does, perhaps even Lance and his team at Real Investment Advisors, schedule a free consultation with the advisors that we recommend by going to wealthion.com, filling out the short form there. Only takes a couple of seconds. These consultations that you have are completely free. There's no commitment to work with these guys. It's just a public service that Lance and our other advisors offer. And with that, if you have enjoyed the weekly market recap, which, Lance, we started the first week of 2022 as an experiment. Yeah. Seems like that experiment's come to a good end here. But folks, if you agree, let us know by hitting the like button and then clicking on the subscribe button below, as well as the little bell icon right next to it. Lance, buddy, I hope you have a great time on vacation next week.
Yeah, me too. Hopefully I'll come back without cast.
So. Yes, please do that. Come back alive and uninjured, or as uninjured as you can manage. And everybody else, thanks so much for hanging to the end of this very long recap. Have phenomenal holidays, whether it's Christmas, Hanukkah, Kwanzaa, Festivus, whatever. And look forward to seeing you here next week with Michael Leibowitz. Thanks so much for watching, everybody.